Good afternoon, everyone, and welcome to our webinar, The Money Fight for SIA Wealth. We are thrilled to have everyone join us. I know it's going to take a few minutes to have people dial in. We're just at 1 minute past 1 o'clock Eastern Time, 11 o'clock Mountain Time. It's Ted Bader here, President of SIA Wealth. I'm just doing the introductions and some housekeeping. Jeremy Fehr is going to be talking for most of the webinar, explaining what it is we're trying to do from an artificial intelligence point of view. And then Paul Vendrinsky is going to talk a bit about some of the funds and how we actually apply the rules and methodology of SIA charts into our into the funds that we run for BMO. So I hope everyone received A, the invitation, and B, the hard copy of the invitation. It's supposed to be just to get you aware of the upcoming money fight, and we wanted to highlight the robot versus bear, obviously the robot being the support that you as an advisor receives from SIA. And we're looking forward to having a good, robust conversation about this. If there are any questions during the course of the webinar, please type it into the webinar. We will try to answer as many questions as possible, but we want to be conscious of time. So please don't, we're not going to take questions verbally, but we will answer questions through the message of the webinar, and every question will get answered. It just might not get answered during the time allotted. So that's enough for me. I'm going to kick it off with Jeremy Fehr, President and Founder of SIA.
Thank you, Ted, and welcome everyone to the Money Fight. Today's webinar is going to discuss the rapidly changing environment for investment advisors and put head-to-head artificial intelligence and bear markets. Advisors are faced by dozens of new challenges, but the most pressing are market declines with an aging client base, and technology, which is threatening to replace you. SIA is one of Canada's oldest fintech firms, now entering its 20th year, and from day one has been built to support advisors now more than ever. Let's get started. So a little background on myself. I'm the founder of both SIA Charts and SIA Wealth Management, but I started originally as an investment advisor back in 1998 and was fortunate enough to see the bull market that was just ending in its last couple of years before the crisis in 2000. It occurred to me while being an investment advisor, though, that I needed to find a way to evaluate the market and get my clients out of bear markets, to get them away from it. So in March of 2000, I started developing the technology that is now SIA Charts and was able to miss the downside, the majority of the downside for my clients within that 2000 market. So risk management's always been something first and foremost with what we've been doing at SIA. I wanted to find new ways to manage money, and we've now built a team of 20 people around us that are all involved in managing money using technology, using database, using queries, and now using artificial intelligence to evaluate the market and create strong portfolios that you can now access through SIA Wealth Management, through our partnerships with many different firms. We've got partners with advisors through SIA Charts. We're now 550 strong in that area. We've got relationships with SIA Wealth Management, with BMO Global Asset Management, with Hollis Wealth, with Wellington Altus, with Harbourfront, and finally Richardson GMP. So for the last 20 years, we've been one of the foremost technical companies or technology companies within Canada, quietly flying under the radar, but all the time developing what we feel is world-class technology that's going to help you guys manage your clients and, more importantly, manage some of the risk that's coming in the marketplace given the time horizon for our clients. So in the presentation today, we're going to cover 3 different topics. We're going to take a look at some recent bear markets and do some evaluation on what happened in those bear markets as far as downside and what was the time that it took to recover for our clients. I'll do some market commentary. It's been a very, very interesting 12 months, and we've had a lot of success and a lot of positive feedback from the webinars that we started back in October. So this is going to be, there's going to be an update in here on what I'm looking at as we go forward in 2019. The third topic we're going to look at is artificial intelligence in finance. We're going to look at some of the areas where AI has been affecting the market, and we're going to talk about what it is and what it means to you as far as a threat, but more importantly as an opportunity, working with SIA, how we can alleviate some of that risk for you. So first, we'll start with our bear market analysis. One of the most important factors in managing money today is that our clients are not close to retiring, they are retiring. So they're already in the retirement phase. We're seeing a lot of baby boomers are retiring, but looking forward, starting in 2020, there will be over 425,000 baby boomers that are set to retire each and every year going forward for about 9 years straight. So that's a tremendous amount of people that are going to be retiring. When we had our the first bear market we're going to talk about today was in 2000. When that happened, our clients had roughly 20 years to retirement, so they had time to recover. In 2002, which was a continuation of 2000, but had another dramatic leg down, they were 18 years away from retirement. The big one that really caused the biggest shakeup in our industry in 2008, our clients roughly had 12 years to retirement. But now we're sitting here in 2019 with only 1 year before they could be possibly retiring. So the first bear market I want to look at here, I didn't annotate these charts today. I left them clean. I think the declines speak very, very well for themselves. In 2000 to 2002, looking at the S&P 500, we had a 49% decline. It was 31 months from peak to trough, so it was a very long time, nearly 3 years from the start of this crisis until the end of it. And the NASDAQ was down even more, plunging 75%, because the breaking point in this bear market was technology, as we can all recall. If we look what happened in 2007 to 2009, again, a very, very strong decline in the S&P 500, a little bit deeper this time. We had a 57% decline, and more importantly, it took 5.5 years to recover when that correction happened. If we look at 2008 and 2009 for the S&P TSX composite, it started a little bit later. We had a little bit more time before the bear market rolled in on us in Canada. Very, very similar to what we saw in 2000. If you think back to 2000, Nortel kept our index climbing right until September of 2000, 6 months later than what it was in the United States. But the decline came in 2008 much, much steeper than it did in the S&P 500. So it came very fast. So even if we are, most people on this call, investing largely in Canada, or competitors are investing largely in Canada, it falls very, very quickly, and the damage was the same, but just over a shorter time frame. So what does this all mean? We have these massive bear markets that disrupt our clients, but as I mentioned earlier, in 2000 we had 20 years plus, and in 2008 we had 12 years plus before our clients retire. But let's take a look at what these look like on the Dow and the S&P TSX. So from 2000 and 2002, we had 33 months of bear. The absolute decline was 37%. It took over 6 years, 9 months to be exact, to get the recovery back in. So that's a long time for people to get their money back. In 2007 to 2009, there was 17 months of bear market. So came almost at twice the speed of what we saw in 2000, with a much larger decline of 53.78. It took 5 years and 5 months for anyone who was at the top to recover to their high water mark. On the S&P TSX from 2000 to 2002, it was 25 months of decline at 50%, so a much, much steeper decline. And we think back to the Nortel networks and 360, those were big components that got hit very hard. It took 5 years and 4 months for clients to get back to where they once were. And then in 2008 and 2009, again, just as we saw in the United States, 9 months is all it took to lose 50% of your money, with 6 years to recover it from that point going forward. So this is one of the things that I don't think gets spoke enough about in our industry, is really how important it is to avoid big losses. Because not only do you lose that money, those clients who are always measuring their lifestyle from a high watermark, but that decline, that loss, takes even more and more money to break even. So a 10% decline needs an 11% recovery just to break even. 20% equals 25%, 25% equals 33%, 33% equals a 50% growth in the market. So even what we would kind of consider the median level of a bear market at 33%, you're still needing a 50% growth rate beyond that to get the money back to the clients. But a 50% decline, as we saw in 2008, can lead to 100% that you need to work back for your clients. And finally, if you're unfortunate enough to be fully invested in the NASDAQ at 75% drop, 400% return is needed to bring your clients back to just the level they were before that. So we have to work significantly harder if we accept these declines than if we find a way to get out of the bear markets to begin with. To visualize that, we've got a chart here of the S&P 500. You can see both of the major bear markets that we've talked about here in 2000 down into the trough in 2003, the early part of 2003, 49%. It took 100% for the market to get even. Everyone finally felt they were getting back to where they need to be just in time for the financial crisis of 2008 and a 57% decline from there. If you look when clients would have broke even from their high water marks of 2000 and 2007, it was 13 years. So it took a very, very long time. 2013 is where people would have seen their high water marks. And this is doubly important if you think what's happening in today's market, where there's been a tremendous flow into indexing funds. We've seen trillions of dollars move in that direction. This is the experience that those clients could see if we have bear markets as we've seen in the past. The other comment I want to make, and this speaks to a little bit of our more recent events in the latter part of 2008, is that for the large bear markets, what we've seen historically is that the market analysis is really not calling for them. So if we look at 2000, we've got a quote here from 2000 and 2007. We see many analysts are coming out and being extremely bullish on our BNNs and on our CNBCs that we're watching, and of course now through social media and many of the websites that are dedicated to financial services, we're seeing all this analysis wrong. When we see the smaller downturns, just as we saw at the latter part of 2018, we almost see everyone dogpiling on it being a bear market. So I think this is a very important fact when you're evaluating what you're doing for your clients, evaluating what we're doing at SIA Wealth Management, is to understand that for the most part, when we've made calls to go to bear markets, no one else was really making them. There's a very, very small minority of investment professionals that were really calling for that bear market. So we have to be cognizant of that, and then that should give you some sort of comfort when you see us going against the trend using our AI, such as the latter part of 2018, where we remained relatively bullish compared to what other analysts were doing. With that, I want to break up the presentation and take a few minutes and go over some of the market as we see it today. So post what we saw from the latter part of 2018, when the Federal Reserve made the call to back off on its interest rate hikes and the subsequent bull market rally that we've seen continuation of it, let's take a look at where we're at today. So one of the things that we noticed in the first quarter and the second quarter of 2019 is that a lot of advisors seem to be relatively frozen because of that fear, because of all the talking heads and analysts that were extremely bearish going into the latter part of 2018. That bearishness continued on into 2019 without really being validated by anything that we can see in our AI. So I just wanted to do an analysis of what it happens if you, for example, look at making purchases on the first business day of May. So sell in May and go away. If you're fearful of the market, you're sitting on the sidelines with a lot of cash. Let's take a look at what the real risk is going forward based on historical analysis. So in this analysis, we've got starting from 2005 when we had our equity action call. For those of you who are not familiar with it, I'll be describing that later, but this is our highest level of analysis on our AI. We've got 14 periods from 2005 right up into 2018 where we have EAC, equity action call analysis. 13 of those periods start in the green zone. Even I was surprised with this. I would have thought there would be a little bit more in the yellow zone when we're going into what is perceived as a very, very dangerous time of the year. With one call in May 1st, 2008, we were actually in the red zone, had moved up into the yellow, but we wouldn't be recommending any purchases. Any of the SIA wealth management products would have been 100% defensive in cash at that time. If we look at the 1-year returns from there, we can see that 13 of these periods 12 out of 13 periods were positive when the EAC is green going into that. Only one negative was May 1st of 2007 till April 30th, 2008, because we'd already seen some weakness and had moved to the red zone in January of 2008, indicating high risk. So if you averaged all of them, even if you avoided, which we wouldn't at SIA Wealth, it was telling us in 2008, you would have an average return of 8.71%. If you listened to the equity action call when it was red, yellow, and avoided that series, your average return would have been 12%. So we can see in plain deal that that sell in May and go away doesn't work as well as it may have used to. The other area that I wanted to point out is that we're in the 3rd year of a presidential cycle. So there's some great stats on what this means. We see the average returns in 1901, 1961, and 1993 from those points forward. And what we tend to see is that in the 1st year of a presidential cycle, we see positive returns, not overly bullish. It's the 2nd year where we tend to see some weakness, getting a little closer to zero. And in President Trump's case, actually a negative number. But in the 3rd year of a presidential cycle, which we are in, for the most part, we tend to see some of the largest stock market returns. So again, this is data that is purely historical, but when you overlay it on the fact that we're looking at a green equity action call going into May of this year, and that we're in the 3rd year of a presidential cycle with a relatively good bull moving at this period in time, that things look a lot better than I think some of the analysts are speaking about in the media these days. The first chart I wanted to talk to you about is our SIA Charts Market Equal Weight Index. This index is comprised of US, Canadian, and international equity. So this is an equal weight index that allows us to see if there is relative opportunity in any of those 3 markets as we equal weight them through this chart. What we can see on the chart, and I understand that some of you won't be point figure experts on this, but I wanted to dig a little bit into my technical background more than I have in other times and start looking at where we could be if we see breakouts on these indexes. So we haven't quite reached it. So we've heard there's been new highs on the TSX, on the S&P. We're starting to see some of that NASDAQ tertiary information. When you look at an equal weight business, taking international and the broader marketplace, not just those cap weight indexes, we're still a little bit behind what we have seen back in 2018 and 2017. So we've been in a consolidation pattern largely since the latter part of 2017 within this chart. But we're very, very close. So when you look at the chart, if you can read it, it says 69,633 is our breakout level. We're watching for that very closely. This is an extremely bullish chart. If you're looking just at this chart in isolation as a technician, having a significantly negative downside, that column of O's that's on the far right, followed by a strong upturn, is a very bullish chart signal. A completion of this would be, in my views, one of the most bullish parts of point and figure charts that you can find. So looking very, very good. We're watching for follow through with a breakout on this. The next chart I want to look at is the S&P 500. So we're going to move into cap weighted indexes. This is what your clients are looking at. For the most part, this is what you're going to be looking at. The S&P 500 is sitting right at resistance. So we're right back at where we were before the crisis started in the latter part of 2018 with a breakout at 29.53. So we're watching for that level. If we look above that chart, we do have potential upside, what I would set for a price target. Obviously, I cannot guarantee this. This is from a technical point of view, and how we measure that is a bit proprietary, but we see upside that looks to be somewhere in that 12% level from here. So if we're purchasing good equities on that breakout, we can expect more times than not to amplify those types of returns. If we pick poor equities, we would expect to be under that. But on the S&P 500, again, this is the absolute most bullish chart signal that I know in point figure that gives a high probability. So that probability is probably sitting in my head somewhere around 7 out of 10 events that this is going to return a positive return for us upon its completion of this breakout. So that's strong odds for us, and again, highlights our equity action call sitting in green. The S&P TSX Composite Index looks like a very, very similar chart to the S&P 500. And for those of you who have been on our webinars of late, you know that we've been holding back on our Canadian enthusiasm because of its ranking in our asset class rankings, which I'll speak to in a few minutes. But this chart, again, looks reasonably well. We're sitting at those highs pre-2019, near the latter part, about the same time, October of 2018. We're back at those levels. If we get a breakout, there is a resistance level. It's a little bit closer than what we saw in the S&P 500, but still 10% potential upside on that breach. So again, looks very good, and we're watching this chart very closely with a green equity action call. We're again optimistic on that. The NASDAQ Composite is one of the few charts that we've seen on the index level that has broken out. So the level 8,110 was an official breakout. It has now gone past its highs of 2008, October of 2008. And again, a very, very bullish chart. So we saw that downturn, and we spoke to it in previous webinars where we were talking about how the market collapsed very, very quickly. Most of that decline happened after the Fed announced that it was going to continue to be hawkish on interest rates going forward at the latter part just before Christmas. We saw 2 strong days come down. The Fed came back and pulled away those comments and said it would be a little bit more dovish. The market liked it, and we rallied back. So that's a very, very bullish pattern. The market bullied, got what it wanted out of the Fed, and then continued its bull market run. So we see about 12% potential upside before the first level of resistance on this chart as well. I wanted to pull up crude oil, certainly an important topic on what's been happening in Canada. One of the main reasons why we've seen some lagging in Canadian markets versus some of the others, although Canada has been improving, and we're hopeful that that technical analysis will continue to show strength there. So it's taken out multiple resistance, hit a low of 42.86 back in early January, has now bounced back over 50% up to that 64 level, so or just under 50% to the $64 level. Gone through multiple resistance levels without even slowing down. So that's a remarkable sign. It speaks strongly to the bullishness, but we're now finally back into the real resistance that we got to watch for. That 66.77 level is an important resistance level. That comes near the bottom of that consolidation pattern of 2018. We're looking for that, and then an expectation, if it gets breached, to test that $75, $77 level, and from there, great things could happen. So watching crude, it's still very weak on an SMAX scale, our shorter-term AI indicators, but improving greatly over time. The U.S. dollar, Canadian dollar relationship is a very important chart to us. This is, again, gauging where money flows may be going between the United States and Canada. And for the last period of time, really since the latter part of 2011, we've seen that the money flows have been dramatically to the United States. In 2016, the Federal Reserve intervened on a market crisis with a weaker dollar strategy, which was effective, caused 3 months and 3 days of downside within the U.S. dollar. We saw in 2017 that the Bank of Canada got a lot more hawkish and started to raise rates. They raised 50 basis points quickly. That was not anticipated. Again, we saw the U.S. dollar fall versus Canadian dollar for a few months and then moved on. About 6 months we've seen in change, we've seen declines, but the uptrend remains in place. Near term, we have seen recent weakness. There's a column of O's, which shows that there's been some downside in the U.S. dollar versus the Canadian dollar, but the chart's not showing that we were almost into a reversal mode on the U.S. dollar. The last few days, the dovishness that came out of the Bank of Canada has really spawned off some additional strength in the U.S. dollar. We're really going to have to watch for that 137.81 level. If we see that, we would expect that what we've seen since the fourth quarter of 2011 will continue to go, with U.S. assets being favored over Canadian ones but we'll wait and see how that goes from here. One of the changes, one of the things we like to do with our technology, and it was highlighted, our AI was looking through, is that we see a new leader within our sector. So when we watched going into the downturn of 2018, looking at the sectors that were there, we saw some change up in it. Post going back into essentially bull market status in the early part of February, we did see one sector that's come out and leading, which is the semiconductor index. So the SIA Electronics and Semiconductor Equal Weight Index has moved above, and so if we look at the chart, we can see that it hit new highs early part of April here. So this is a sector that's been leading the charge, new ideas, and you'll see that our portfolios are being populated with more and more names from this sector. So this is a leading breakout within the sectors, one to watch as we see other sectors maybe tail off. So we've seen health services and some drugs tail off. We'll see if they recover. Still in favored zone, but this is a sector that's showing great strength in the near term. With that, we're going to jump off of market commentary and move into what we're seeing in artificial intelligence within the finance community. The first chart I want to talk to you about is talking about Bloomberg's Alpaca forecasting application. And so what we want to highlight in these first few slides is really how artificial intelligence is becoming more and more prevalent within our industry. So financial services has been in there. So there's a number of reasons with that, the obvious being that technology is getting relatively cheaper and cheaper, and processing power is getting cheaper and cheaper. But the main driver for this is really no different than what's happening within your business yourselves. We're seeing compression of margins, we're seeing more regulation, we're seeing all the costs of our business go up and up and up, and we're seeing our margins go down, 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 and demand from clients for cheaper and cheaper products. So the way that big business is fighting this, and the reason is through development of artificial intelligence for the full purpose of replacing human beings in our industry. So this is something that's very important. We've been on this for a number of years, but this is getting more and more prevalent within our industry. So the Alpaca forecasting application, it is a disruption for analysts. So it's going out there and giving you up, down, or neutral recommendations on investments, the same way that an investment an investment analyst would in their day-to-day jobs. To reduce that, to scale the business, and to reduce costs and over time. The next one that we wanted to talk about is a disruption for traders. Goldman Sachs electronic trading platform, again, another artificial intelligence platform that is running comprehensive algorithms to help clients achieve trading goals. So this is replacing traders. Another area where getting more and more prevalent, and we hear lots of statistics coming out of the industry where it's 60, 70, even 80% of the trading that we're seeing on our markets is coming from electronic providers, just like the Goldman Sachs electronic trading. But again, the reason for this is that traders have traditionally been very expensive employees, demanding lots. Now you can have a team of 30 number of programmers that can replace hundreds and hundreds of traders at a significantly lower cost, and disrupting what we've seen in traditional trading through our firms. The third one we want to talk about is JP Morgan's Contract Intelligence, their COIN platform. This is a disruption for lawyers. So it's using artificial intelligence to read through legal documents and to find precedents and areas like that. So this is happening quite a bit in what we're doing in our industry. It can go through prospectuses, it can go through all the multitude and the continuing to grow database of documents that are expected from financial firms to go through to make decisions and to set up new products or continue to maintain products. So this again is a massive disruptor to the industry, one that is growing and is likely to replace significant human beings that many of us would have had relationships with, will now be jobs at risk within our sector. So one of the myths is that this is really not coming at us too fast. This slide here really shows in depth what's been happening in the fintech area and how much more money has been invested into disrupting what has been traditionally man-powered or human-powered decision-making trees. So we're seeing this here. These are all just the top 250 fintech companies that have been organized and brought forward lately, with more and more of these coming on online. So the growth of fintech, the growth of artificial intelligence is something that is already within our lives, and it's something that is exponentially growing on a go-forward basis. In Canada, we're not immune to this. We're seeing many partnerships between our big financial institutions and artificial intelligence. So again, we're going to have to be very aware of what's been happening in here. And so if you think of some of the advertising that we've seen on TV over the last few years, we're seeing robo-advisors coming out and competing with us as far as attracting clients, and doing so at a much lower cost. Right now, robo means essentially just automated back office, but it won't be too long before these fintech firms and AI start developing processes that they can offer strategies and portfolio strategies that will also be determined by computers in a way that will directly compete with you at a significantly lower cost. So with SIA Charts, this is a platform that we've been working on now for over 20 years. So again, I started this back in March of 2000 when we crossed March recently. That was our 19th anniversary. And what's important about our 20th year at SIA Charts is that we're going to be launching our newest technology this year. We call it internally Phoenix. We've got a few screenshots through this presentation shown here. But what's important about what we're doing with Phoenix is that we've developed this thing from the ground up. It's been developed to work as an AI platform, unlike our previous platform where we've been completely automated in our investment decisions. But what we're able to do is we're able to stick significantly more data, and I mean exponentially more data. We purchased it. We can do that. We can do significantly more analysis on an overnight basis. Even with the growth in computers from when I started this in 2000, you still need tremendous processing power to get through the data. We're going to have more marketing features within this for our advisors, and there's going to be more ways to build strong portfolios. We're building off of our relationship with more than 500 advisors who are using the platform, but we're also building off of SIA Wealth, which now manages over $1.1 billion using SIA Charts, using all the AI and the technology within it. And it's also started to develop its own technology, has its own programmers now. And what's important for it, for those of you who are familiar with our business and those of you who are looking for an AI platform that can be used for you and can be used to combat what is coming down the pipeline with other fintech analysis that's there to steal your job, is that SIA Wealth Management, through our funds, is providing 100% of the research and development budget of that. So when you see Phoenix, when you see all the new technology that comes out with it, and when you see the adaptations that we're putting into our SIA Wealth Management products, it's been that growth in our wealth management firm that has tremendously funded what we've seen there. We're currently running about 10 billion calculations every night. We expect that to grow over the next 12 months to over 100 billion calculations every night. We're going to have a more real-time analysis. So as data comes in, the evaluations will be learning on what a specific market, a specific sector, a specific individual security is doing relative to its peer group, as we've always done, but also relative to itself and how it's performed in the similar markets over time. So again, our technology is becoming significantly more robust, and these are things that we're already using at SIA Wealth. And what's most important about this is that our AI is a foundation for advisors. It's not just there to help you defend your book of business, but it's there to grow. The vast majority of advisors across Canada and the rest of the world are still relying on strategies that they used before 2000, before 2008. And now that our clients, our baby boomer clients, the majority of the wealth in this country are moving into retirement, they're not going to have time to recover. That's going to dramatically affect their retirement. This will offer all of us probably the greatest opportunity to gather assets in the history of our businesses. So how does it work? For many of you who are familiar with SIA, this will be just a go-over for you. But again, here's our here is our money flow analysis. So we look at global money flows. There's about $212 trillion that are flowing around within 7 asset classes. There's international, Canadian, and U.S. equity. There's commodities, currencies, bonds, and cash. So again, as our AI develops and as it sits today, we're monitoring how this money flows around the world. Most of it is managed by very, very few hands. So as that money moves around, we're going to see where that money moves between those different asset classes and make determinations on that. We have 4 levels of analysis. We have our equity action call, our highest level of analysis, our asset class rankings, our sector rotation, and then our investment selection. So we start from a top-down approach in how we do things. Our first chart that I'm showing you here is our equity action call. This is our barometer. Simply answers to us whether money flows are positive in U.S., international, and Canadian equity versus the other 4 asset classes. If it is, then we're in the green zone and we can be more bullish and want to overweight our equities to the top of that. You'll see this in all of our SIA Wealth Management portfolios, that we will be overweight when we're in the green zone to equities as much as we can. When we move in the yellow or the neutral zone, this is suggesting that money flows are equal between equities and alternatives. We can probably find less risky assets to hold during that time frame. So you'll see us, when we have stops in our investment portfolios, holding cash to diversify away from risk, just in case, as it happened in 2000 and 2008, where we went to the red zone and had tremendous downside in the market. Our next level of analysis is our asset class rankings. And here we rank those 7 asset classes. This is a current ranking: U.S. equity on top, international equity, third is cash. This is still remaining after the weakness that we saw in 2008, with Canadian equity nipping at its heels, but still not quite there. Bonds, currencies, and then finally commodities. So going back to that oil chart I showed earlier, commodities still ranks very, very low in our asset classes. We focus all of our attention on the top 2 asset classes. So our AI shows that money flow is continuing to go into U.S. and international equity, and we'll dig within that to find our greatest opportunities. Our third level of analysis is our investment selection analysis. And in here, we're going to rank, we're showing the S&P TSX 60 index. We'll go find where the money flows are going within that index with Shopify, Constellation Software, Waste Connections, Bombard, J. Thompson. So if you look at our Canadian mandate, which we're going to speak to here in a few moments, you'll see that we don't have a lot of traditional energy, banking, or metals and mining, because they're not the leaders. That's not where the money flows. That's not where our AI is showing us to go. With that, that concludes the first part of the presentation. I'm now going to hand it over for just a brief conversation on our products. Paul Vendrinsky is our portfolio manager, and I'll turn it over to him to continue the presentation.
Thanks a lot, Jeremy, and welcome everyone, and thanks for joining us here today. As Jeremy mentioned, I'm a portfolio manager here at SIA Wealth, and I just wanted to quickly show you some examples on how we're using this technology on a daily basis with our team to manage a number of our live mandates. Over the last number of years, we've been fortunate enough to work with a number of financial institutions across the country. Our very strong relationship started about 5 years ago. BMO Global Asset Management and SIA Wealth partnered to bring, over this period of time, 5 very unique investment products, utilizing that proprietary investment approach that Jeremy was just covering, and which really allowed us unconstrained flexibility for all of the funds that we manage. And this is very rare in our space. So I'd like to talk to you about some of these products. Firstly, these are 2 of our most recent funds, launched in early December of last year. These 2 highly anticipated additions to our lineup bring together a concentrated and unconstrained individual stock portfolios. And I specifically say stock portfolios because for a lot of you who've known us or followed us, our flagship products over the years have been mostly ETF based. So these were highly requested strategies, and after a fair bit of R&D, we're very pleased to announce and present the, first of all, the BMO SIA focused North American Equity Fund, also set up as an ETF trading on the TSX under ZFN, and then the BMO SIA focused Canadian Equity Fund trading also as an ETF under So just to give you a quick snapshot on each, the North American fund here allows us to use this technology to really drill down into where we're seeing specific strength within the Canadian and the U.S. equity markets. Most approaches don't do this. They do one or the other, a U.S. fund or a Canadian fund. And I'll tell you why in a second. We're looking at a large basket of names, and we're positioning ourselves using the relative strength rankings to continue to expose the portfolio to the top performers, and obviously, and of course, to avoid the weaker sectors. And this includes the net effects, positive or negative, of currency. We're looking at the best places to invest. This could potentially be all in the U.S. We could be 100% U.S. equities or 100% in the Canadian side. Most likely it's going to be a combination between the two, but the relative strength rankings are net of currency effects, which means we're never hedged. If we're heavily weighted, say, to the U.S. side, it's because net of the U.S. CAD relationships, we're seeing strength there, whether it's because partially because of the currency or because of the returns on the stocks or one or the other. That's where we're going to weight into the portfolio. If and when this does change, the portfolio will definitely shift accordingly. Here you can see on the slide, here's our top 10 holdings. And you can see from our sector breakdown that it is quite diversified. By buying this, you're really allowing us, giving us the responsibility to decide what side of the border we want to be on and where to invest. And a big part of this is going to be the foreign exchange transaction cost, which we keep hearing from a lot of guys being a detrimental part of their the cost for the client. So what we're hearing from a lot of advisors a lot of time is that unless the clients give them a chunk of US dollars already, they're generally not going to be flipping back and forth between the border. So this is where we're able to get preferential pricing and perform the foreign exchange well that way. If we look at the our other new one, the BMO SIA Focus Canadian Equity Fund, this is really for investors looking for a high conviction Canadian equity investment portfolio. We're scanning, ranking, and holding here the strongest stocks within the Canadian markets. And one thing you might notice here, if you look at our current holdings and also the sectors that we're currently exposed to, is that we're very uncorrelated right now to the traditional Canadian equity fund. Whether you're looking at Canadian equity funds or ETFs, usually the Canadian landscape is predominantly what sectors, right? We're usually energy, metals and mining, Canadian banks. So I know since this has been launched in December, a lot of advisors and investors have been using this within a sleeve of already Canadian equity funds to diversify outside of that, because we wouldn't own anything but. As you can see here, we have exposure to real estate, tech, communications, industrials, a lot of names that traditionally you don't hear about in Canada so much outside of the main three. Of course, the portfolio is not going to always look like this when the traditional names, energy, metals and mining, Canadian banks, rank high. The portfolio, of course, will shift to that way. And I didn't mention this on the last slide with the North American Equity Fund, but with all of our mandates, they are tactical and unconstrained, meaning we have the ability to shift completely away from equities if and when it's necessary. So we're able to actually move this fund, even though it's an equity fund, into 100% cash when, as Jeremy mentioned, if we see the equity action call signaling to us ultimately that the risk versus reward for equities as compared to, say, cash has shifted. So we're able to do that. We have that flexibility. Moving ahead here, looking at one of our most popular products here is the BMO Tactical Global Asset Allocation Fund. Quite the mouthful, I know. This is our global balanced fund, and we're very proud that it was the #1 ranked fund in its category in Canada for 2018. And I'm assuming because of this and the returns we were seeing last year, was also one of the top selling BMO funds for the year. So it had a very strong 2018, and it's soon to hit its 3-year anniversary at the end of this month. So just in a few more days, we're very excited about that, and we'll be coming out with some literature on that for the fund. Hitting that 3-year mark is a big hurdle. Now, as far as the fund, it combines holdings of equity ETFs, bond ETFs, and individual stocks. We are, in this fund, actually restricted to holding a minimum of 40% in fixed income at all times, which compared to some other balanced funds that can go to 100% equity can be seen as a disadvantage. Now, I don't really consider it to be one. If we look at what happened, say, over the last 5 quarters, within this fund, and part of the reason why we had such a great year last year is that for the first half of last year, we saw the largest gains from our equity exposure. We have a stock component that did very well. As we moved into the fall, specifically in October of last year, things really started to change, and our system, our indicators actually moved our 40% allocation of fixed income all the way to 60%. So we're 60% fixed income. We actually started generating a little bit of cash, and because of this, this cushioned the equity weakness that we had saw at the time. The other thing too, and really this was our equity action call, our AI, signaling caution. When we look at what this fund has done in the internal components over the last 9 months, it's really the bond holdings which has given it such a run here. We'll look at we have a standalone bond fund that we'll look at in a second, which actually happens to be up over 10% over the last 1 year. But it was that component within this fund and the same components within that other fund that helped us generate such a good year last year, and coming up on our 3-year number, close to around 8.5%. We'll see in a few days. But it was the tactical shift within the portfolio ultimately that allowed us to move from equities that were hot and helping the portfolio into the new strength, which was fixed income. That's changed since earlier this year. Now we're back shifted to 60% equities and enjoying the run here. But this is an example of the tactical approach that our strategy allows us to do in real time in this portfolio. Now, as far as this fund, some advisors are using this, if not as a core position, and some definitely are, but some use this as an inclusion into, say, a 60-40 portfolio. You have a 60% equity, 40% bonds, for instance, and depending on what percentage weight of this fund that you might add, you have the ability to shift over time depending on our equity action call. And it will do this automatically for your clients. So, depending, of course, on the weight, you have a potential of moving from a 60-40 portfolio to possibly a 40-60, 40 equities, 60 during a prolonged slide. And the reason why is because this portfolio would move 100% of its equities out. And that would shift your overall asset allocation within a client's portfolio. So that's, as far as I'm concerned, that's real tactical. That's a real tactical movement within a portfolio. Finally, we'll just look at here's a performance snapshot of our 3 original funds, the asset allocations at the bottom there. But first, we'll take a snapshot. We'll take a quick look here at the BMO Tactical Global Equity ETF Fund. This was launched just over 4 years ago, and it has gone through definitely some very interesting markets. Now, even though it has the name equity in its name, the fund since inception has gone from 100% equity to 100% fixed income to 100% cash and some combination between it all. So you can almost think of this almost like a balanced fund, a little bit different than a tactical asset allocation since we're not restricted on ownership of set fixed income, but it is morphed and changed over the past 4 years. So if you think about what's happened over the last 4 years, think about, maybe we'll start in 2015. 2015, it was U.S. denominated investments that saw the largest gains, and this portfolio had exposure to that. In 2015, it was a combination between the stock performance, but a big part on the currency side in the U.S. That's where we saw most of our gains. Later in that year, however, due to a combination of economic uncertainty, central banks saying one thing and really doing the opposite, this happening on both sides of the border, the broad market volatility came in, and the portfolio and the system really told us to take our foot off the gas. When this ultimately cleared, central banks came in, did what they did. We were able to get back into the markets in early 2016 until fall of 2016 presidential race. So I'm just going to give you examples on how there were so many shifts and changes within the markets, and the portfolio moved along with it. Into that presidential race, we were seeing specific sector names move around, not so much the broad, it was in the sector. And after Trump took office, things cleared up, and then we saw obvious strength in tech, healthcare, pharma, aerospace, semiconductors, which the fund was able to take advantage of and shift into. Our indicators again signaled caution into the fall 2 years later, like I mentioned in 2016, very similar to 2 years prior, where the central banks were really pulling 180s on what they were saying to prior meetings. But overall, the fund was able to shift from equities to some cash to be defensive. So overall, during this uncertain times, the fund was able to shift on where the strength was. Just a quick note here below, I mentioned the bond portfolio. Now, this is the BMO Tactical Global Bond ETF. This is a fund that primarily invests in investment-grade corporate and government bonds, but most importantly has a fixed income. It looks at fixed incomes denominated both on foreign and local currencies. So this allows for diversification within a portfolio into sleeves that traditional investment-grade Canadian portfolio might not have too much exposure with. Again, using our system allows us to make these shifts within country, duration, and credit quality. So I just wanted to throw these out as examples on how we're using our strategy to do that. I'd encourage you to contact us if you had any questions about these. And with that, I'll just pass this back to Jeremy, who can end this. Thank you, everyone.
Thanks, Paul. Thanks for a great description of our products. And certainly we're very, very proud of our lineup with BMO Global Asset Management. They've been great partners. You'll get excellent servicing from their wholesaling team. And again, as much support as we can offer at SIA Wealth Management and SIA Charts. We do have some questions, but we've run over time here, so I want to be respectful to all of you about the time commitments here. So we will answer all these questions directly to the people who have asked them, and any of the ones that would be broad-based we'll put up on the website when we have the replay link for this and send it up. There is one note I want to make a comment before we leave today. Is that if you're interested in our AI, you're interested in the development of it, SIA Charts will be doing a conference within Calgary at the Calgary Stampede from July 3rd to 5th, 2019. So this will be an opportunity. There'll be 2 days of seminars there going over our technology, going over our artificial intelligence, going over a lot of the new features that are getting built into our technology. So this is a very, very small conference. There's limited space. So if you have any interest in that, please sign up. You can go to the siacharts.com website. Its workshop will be listed on there, and you can go to that and sign up for this conference. If you have any questions around that, by any means, reach out to any of our members. So again, I thank you. It's a very exciting time to see SIA in both SIA Wealth and SIA Charts, the distance that we've come over the last 19 years, and the excitement that's building around our product base for 2020 and our many launches and many changes to our products. So again, thank you and have a great day.